This is Satya Pradyuman of Cirrus Research.
We just published the earnings playbook report. This is a quarterly report that looks at the earnings season. In this report, the title is Earnings Misses and the Cockroach Theory. A brief reference to the cockroach theory. I think if you're a city dweller, you kind of get it. The idea is that if you see one, you're bound to see more. So our message in the last few quarters has been, hey, earnings should be decent. It's the guidance to look out for. As we begin to see misses, it may be the start of something. Part of this has to do with all the pressures on commodities, the Fed risks, and the sort of peaking of the profit cycle where the comps are just right to be slowing. In our quarterly outlook, we did flag the need to focus on the earnings season. We believe that it's earnings expectations that will allow us to figure out a bottom, not valuations. As a result, really honing in on the firms you own as they're going into the reporting season is very important. We've been publishing this work on earnings torpedoes for quite some time. I think they've just become a lot more important as the profit cycle is about to get squeezed. So the concept of the earnings torpedo is that look out for those firms that have the highest expected growth, where the dispersion in estimates is terribly narrow, or as we call high conviction. So bottom line, if the analysts love the stock and they're sure, look out. Conversely, we also find we can use this concept to flag firms that have really been flushed out with expectations, and the sell side is coming to some sort of convergence that they know that maybe the worst is behind. We think these are super important, especially in this period where you've got tons of volatility and a profit cycle slowdown. Both models should matter here. One in terms of just being cautionary, and the other is for opportunities as markets sell down. The other point we flagged here, a few areas that we focused on. One was the financial sector. And in this segment, what we relate is our two very different takes. One, to the left panel, is a look at earnings estimates for banks, large and mid-cap banks, where the expectations are still fairly lofty. And to the right panel are the investment banks, where expectations have really tumbled to near secular lows. In other words, the sell-side analysts have been good to recognize that given the break in speculative assets, the underwriting for such assets are going to be fairly thin. Still an area to look out for as the market continues to price in the challenges of a Fed tightening and commodity prices and inflation. This also covers the risk that we have flagged in big box stores. The idea is that the consumer discretionary expectations should continue to fade lower. While we may not necessarily go into a recession, I think stocks care about a bottoming in earnings estimates, and it seems very hard to see that bottom this early. The earnings revisions data here, the purple line, makes that case as well. This reading could actually be quite a bit lower. Thank you very much. Take a look at the report. With any questions, feel free to reach out to us. Thank you.